You probably don't spend money recklessly. You're not blowing thousands on designer bags or flying first class. You buy groceries. You pay your bills. You get the occasional takeout. You live a pretty normal life. And yet, at the end of every month, you can't figure out where it all went. Here's what I want to tell you. You're not bad at money. You're just paying for decisions you made months ago and completely forgot about. And those decisions are probably costing you at least $500 every single month. Not because you're irresponsible, because the system's designed to drain you quietly, in amounts so small you never feel the hit until you check the total. In this video, I'm going to walk you through exactly where that $500 is hiding and how to get it back without turning your life into a budget spreadsheet or a punishment. Here's why most people give up before they start. When they hear cut $500 a month, their brain immediately starts doing math that feels impossible. $500 is a lot. That's rent in some cities. That's groceries for a family. So the assumption becomes, to save $500, I'd have to stop eating, cancel my internet, and sit in the dark. That's not what this is. The reason most people can't find $500 to cut is because they're looking in the wrong place. They're staring at the big, obvious expenses, the rent, the car payment, the utilities, and thinking, I can't touch any of that. And they're right, you probably can't. But that's also not where the $500 is hiding. Here's what most people don't realize. The $500 rarely lives in one place. It's spread across 12 to 15 separate decisions, most of them costing under $40 each. You never feel them because $14.99 here and $8 there doesn't register as a problem. But add up 12 of those and you're already at $150. Add in a few more habits, a couple of forgotten subscriptions, and the convenience fees you pay without thinking, and $500 gets there faster than you'd expect. According to a 2023 study by C+R Research, the average American spends around $219 per month on subscription services alone, and most people guess they spend about $86. That's a $133 gap per month, just from subscriptions they don't fully remember signing up for. So no, you don't have to overhaul your life. You just have to know where to look, and that's exactly what we're doing right now. And in a few minutes, I'm going to show you the one category most people completely ignore that's probably bleeding $80 to $120 out of your account every single month. And fixing it takes one phone call. Most people think they know what they spend. They don't. Not because they're careless, because the way modern spending works, it's designed to be invisible. Small charges, auto renewals, digital transactions that don't feel like real money the way handing over cash does. So before you cut anything, you need to actually see what's happening. And I want you to do this with a very specific lens. Pull up your last 60 days of bank and credit card statements, not your memory, the actual statement. And as you go through them, sort every transaction into one of three buckets. Bucket 1. Things you'd pay for again today if you had to decide right now. Keep those. No guilt. Bucket 2. Things you're paying for that you've been meaning to cancel or haven't used in 30+ days. These are the leaks. Bucket 3. Amounts you paid more than you expected to, or didn't remember charging at all. These are the hidden bleeds. Most people, when they do this exercise honestly, find $60 to $100 in Bucket 2 and another $40 to $80 in Bucket 3. That's $100 to $180 right there before you've changed a single habit. Here's the psychology piece. We're not great at tracking small recurring charges because our brains treat them as already decided. The decision happened months ago, so our brain files it away. The charge comes out automatically. We don't reevaluate it. We just absorb it. The only way to override that is to literally force yourself to look at it in writing and make a fresh decision today. Would I sign up for this right now? If the answer is no, that's a leak. Most people think the hard part of this is saying no to things they enjoy. It's not. The hard part is saying no to things they forgot they were even paying for. That's what the next section is about. Subscriptions are brilliant for companies because they exploit a quirk in how we think about money. We pay once, we feel the pain once, and then it just fades. The service keeps charging, we stop noticing. Here's what this looks like in practice. You sign up for a free trial of a streaming service during a long weekend. You forget to cancel. Now you're paying $17 a month for something you've opened twice. That's $204 a year for content you're not watching. You joined a gym in January. You went 4 times. It's now June. That's $35 a month sitting on the ledger of past motivation. You subscribe to a premium app, a news site, a meal kit service, a cloud storage plan you don't need. Each one felt like a reasonable decision at the time. None of them would survive you asking, would I sign up for this today? Here's the audit I want you to run. Go to your Apple or Google subscriptions page, then your PayPal, then your bank statement. You're looking for anything under $25 that charges monthly or annually. Under $25 is the sweet spot for companies because it's below the "this hurts" threshold. You absorb it, you forget it. That's the business model. Cancel everything you wouldn't consciously resubscribe to right now, not the stuff you use and love. The stuff you're sort of passively keeping just in case. For most people, this gets you $60 to $120 back per month. I know that sounds like a lot. Go look at your statements and come back to me. One more thing on subscriptions. Annual fees are the sneakiest version because they hit once a year and feel like a one-time expense. But $120 a year is $10 a month. If you have 3 of those, that's $30 a month you never counted as a subscription. Let me tell you about someone I'll call Daniel. Daniel made decent money. His income wasn't the problem and his lifestyle wasn't extravagant, but when I sat with him and went through 3 months of spending, we found something interesting. Almost $200 a month was going to what I'd call convenience charges. And he had no idea. Convenience costs are the fees you pay not because something is good or enjoyable, but because you didn't plan. And they come in a few forms: delivery fees and markups. Ordering food through an app costs 20 to 40% more than picking it up or making it yourself. The app charges a service fee. The restaurant charges a markup to compensate for the platform. Then you add a tip and sometimes a small order fee on top. A $15 meal becomes a $24 experience. Do that 4 times a week and you've spent $384, and the same food, $240 instead of $224 in Sustance's food. That's $144 a month in friction costs. Late fees and penalty charges. Missed credit card payment, $29 to $40 gone. Overdraft fee, $25 to $35. Library fine, parking ticket, whatever it is. These aren't inevitable. They're the cost of not having a system, and they add up to a surprising amount when you add them across the year. Last-minute prices. Flight booked 3 days out. Grocery shopping at the most expensive store because it's the closest one. Buying something at full price because you forgot about the Amazon cart you left it in and the deal expired. Convenience has a surcharge. Planning has a discount. Daniel's $200 didn't come from any single decision that felt expensive. It came from dozens of $8 and $15 decisions that all shared one characteristic. They happened because he wasn't thinking at the time. Not bad judgment, just autopilot. He told me once you saw it written down, he wasn't even that upset. He said it honestly. It's like finding money I didn't know I lost. That's the thing. We're not fixing irresponsibility here. We're fixing default settings. And there's one more category that nobody talks about, where your settings are costing you the most. Here's where most expense-cutting guides completely fail you. They tell you to cancel your subscriptions and make coffee at home. Fine. But they skip the biggest opportunity on your entire statement, the bills you think are fixed but aren't. Car insurance. Most people pick a plan, set up autopay, and never look at it again. But your rates can drop significantly if your credit score improved, if you haven't had a claim in a few years, or if your commute changed and you're driving less. Calling your insurer and asking for a requote takes about 20 minutes. Shopping 3 competitors takes an hour. The average person saves $50 to $150 per month by switching. That's not cutting back. That's the same coverage for less money. Internet and phone bills. These companies have loyalty pricing and promotional pricing, and they are not the same. New customers get discounts. Existing customers pay full rate. The fix is a 10-minute phone call where you say, "I've been a customer for 4 years and have been offered a better rate by another provider. Is there anything you can do?" Most companies have a retention team whose entire job is to not lose you. They have offers they won't volunteer. You have to ask. In 2022, Consumer Reports found that 70% of people who tried to negotiate a lower cable, internet, or phone bill successfully got one. 70%. Most people just don't try. Health and life insurance, worth reviewing annually. A lot of people are overinsured or on plans that made sense years ago, but not now. A half-hour conversation with a broker can surface this. Medical bills. If you had any out-of-pocket medical expenses, call the billing department and ask for the cash pay rate or a payment plan. Hospitals have financial assistance programs they're not required to advertise. Asking is almost always worth it. The category of fixed expenses is mostly a myth. These are bills that feel fixed because you decided once and never revisited. Most of them have a negotiation lever. You just have to pull it. The difference between people who consistently spend less and people who try and give up isn't willpower, it's friction. If saving requires constant active decisions, you'll exhaust yourself and eventually stop. If your environment makes the default choice also the cheaper choice, it happens automatically. That's the goal here. The meal prep default. You don't need to become a meal prep content creator. You need 4 to 6 default meals, cheap, fast, easy, that you make automatically when you haven't planned anything. Pasta with a jar of sauce and some protein. Rice and eggs with frozen vegetables. Beans and tortillas. Oats with banana and peanut butter. When you don't have a plan, your brain reaches for the path of least resistance. If that path goes to DoorDash, you spend $22 on dinner. If that path goes to a meal that costs $3 to make, you save $19 every time. The 24-hour rule: any non-essential purchase over $30 waits 24 hours before you buy it. You add it to a list. You sleep on it. If you still want it tomorrow, you can have it. Most impulse purchases don't survive 24 hours. The ones that do were probably worth it. The automatic transfer before you spend. Every payday, before you pay anything, you move a set amount to a savings account that's not your main account. Not a big amount. Whatever you can handle, $50 to $100. The point is that it moves before you spend, not from what's left over. There's never anything left over if you wait. Buying in bulk on things you'll definitely use. Toiletries, cleaning products, non-perishable food staples. The per unit cost is almost always lower. You spend more up front and save significantly over time. None of these are extreme. None of them require you to give up things you enjoy. They're just better defaults. Here's where this gets real. Most people, if they find an extra $500 a month, absorb it. The number in their checking account goes up a little. Their standard of living quietly expands, and 6 months later, they're back to the same position. That's lifestyle inflation happening in slow motion. The money was found, the money was kept, and it still didn't build anything. The fix is to make the money do a job the moment it's freed up. $500 a month invested at a historical average return of around 8% annually becomes roughly $36,000 in 5 years. In 10 years, that same $500 a month is close to $92,000. Not because of any smart trades or risky bets, because the money was working instead of leaking. The most important move is the simplest one. As soon as you identify the savings, route them automatically. If you canceled $80 in subscriptions, set up an $80 automatic transfer to your investment account or savings account. Same day, same amount. You never adjusted your lifestyle to have that $80, so you won't miss it when it moves. If you renegotiated your car insurance and saved $90 a month, that $90 doesn't go into the checking account. It goes into the investment account. You were living without it before. You can keep living without it now. This is the actual long game. Not the cutting, the rerouting. The cutting just unlocks the money. Where you send it determines whether it ever actually does anything. Look, you spent the last 12 minutes finding out that a significant amount of your money is leaving every month in ways you never consciously chose. Subscriptions you forgot about, convenience fees you didn't notice, fixed bills you never questioned. Small impulse decisions that added up to something big. That's not a character flaw. That's just how modern spending works. It's built to be invisible. But now you've seen it. And once you've seen it, you can't unsee it. 5 years from now is arriving, whether you make these changes or not. The only question is whether the $500 a month that's currently disappearing will keep disappearing, or whether it'll be sitting in an account earning interest and giving you actual options. The person who has options is closer than you think. If you want more videos like this, practical, specific, no padding, make sure you subscribe. And I want to know one thing. What's the first leak you're going to fix this week? Drop it in the comments. Saying it out loud makes it real.